Joining us to discuss today is Wells Fargo analyst Stephen Cahall. Stephen, loved your note this morning. Interesting to hear you say that within certain parameters, this deal could work.
Yeah, I think so, and thanks for having me on, Carl. What our sense is that Disney almost has a good bank and a bad bank at this point. Streaming is its future. It's its strongest asset next to the parks. It's the way they monetize all the great content. So that's kind of the good bank, if you will. And then the linear business is something that Disney has clearly signaled is going to be in decline. They're not looking to necessarily protect it. And so if they can start to move some of that lower or negative growth business off the books into a better or more logical operator, we think that's good for the stock.
Is it a better argument for what Nexstar could do in terms of getting into some of the top local markets? Or is it a better comment about what the breakup value of the Disney equity is?
I think it's a little bit of both. But so I think from Nexstar's perspective, broadcast is what they do. They're a really, really well-run company, a great management team. They've had a very strong history of success in buying broadcast assets and doing accretive acquisitions. And no doubt that they could take ABC and continue to monetize that really well. And we think that adds to some of their terminal growth and probably re-rates that company over time. And for Disney, I'm not sure that ABC or some of the linear nets do much in a breakup analysis. These are assets that trade below Disney's multiple. So the breakup bits of Disney are probably some of the bigger and sort of juicier things like the parks or ESPN.
What is the right multiple for ABC? The broadcast stocks trade at pretty low multiples these days, don't they?
Yeah, that's right, Sarah. So what we had in our note last night is they traded about 6.5 times 2-year enterprise value to EBITDA on a forward basis. We think a national network like ABC, which has some of the broadest reach and viewership of any network out there, the big broadcast networks tend to do that, has a lot of sports that comes from ESPN. So we think that would probably transact at a higher multiple, something more like 8 times enterprise value to EBITDA.
Some have written this morning, Stephen, that, ABC, according to some, is losing some relevance. Obviously, the cable providers are getting tired of paying for content that at least subscribers don't need necessarily. So would you expect the field, to the degree there is one, to be very deep?
Yeah, so I think what I would recognize here is that there is a monetization issue in linear, and that's the reason that Disney is looking to potentially divest these assets. So, we make no mistake about that. We tend to prefer companies with stronger growth, and the public markets especially tend to prefer companies with stronger growth. But ABC and assets like it still have a lot of relevance in the national distribution framework. Sports leagues like to ensure that even if they're going to be on streaming, they're also on something that's free to air. We've seen the NFL make that as a linchpin of a lot of the deals that it's done. So we think ABC is going to have a lot of important, valuable content for a long, long time, maybe not exclusively, but it will be there. And so, again, sort of in the hands of a company that's really just focused on ABC and broadcast overall, it's probably worth more than it is under a much bigger, broader content company like Disney.
So if they go forward with this deal, does that mean that they're all in play? Nat Geo, FX, some of the other properties?
I think the reason we see this as a real bullish sign at Disney is that, as you recall, when David Faber was interviewing Bob Iger over the summer, he commented that some of these non-ESPN linear assets could be available. And now we're starting to see, some news headlines suggesting that some real discussions are happening, some real offers potentially are being made. And I think for Disney's investors, it shows that, after a little less than a year under new management, there's a lot going on now at Disney between ESPN and partnerships, between maybe divesting some of this stuff, a lot of the costs that they've tried to take out of DTC or the prices going up. So Disney all of a sudden is feeling a little more catalyst rich than it was more recently.